So the fact that a pattern is common, the fact that it's seen by lots and lots of people, doesn't invalidate the way that pattern behaves, because that pattern captures the psychology of the market.
Welcome back, everyone. Today I'm sitting down with Daryl Guppy, one of the traders I spoke to a long time ago, who trades mostly equities and derivatives as well. So Daryl, looking forward to sit down with you again, discuss some trading and kind of have your thoughts on how to succeed in the market. So welcome back on the podcast.
Thank you very much.
Good to have you here. So I cannot remember how many years since we last spoke. It's probably been somewhere like 5 years or so, maybe more, 6 years. Tell me what's been going on since that time.
I think that would certainly be correct. It'd be 4 or 5 years ago, yes.
So what's new with you since we last spoke?
What's new? Well, I'm still here. That's always a big plus in the sense. And I mean that quite seriously, because people who trade the market tend to disappear on a fairly regular basis. There's not too many who survive through multiple market cycles. And I've been trading for about 27, 30 odd years. So that means that I've been in place through multiple market cycles. Some magnificent crashes, some really nice high points as well. So the fact that I'm still here is significant.
I want to start with a big question, which is, what do you think makes it that some people succeed long term and some people don't? Is it just a character trait? Is it more psychology, or is it how they look at the market?
I would suggest that it's more psychology. It's more a character trait in the sense that it depends on how you approach the market. Of course, in a bull market, everything goes up and people think that they're up there with God. Once the market changes its characteristics, they find that they can't survive because they've learnt bad habits. So as we say, we run with the bulls and we hunt with the bears. You have to know when the market's changed and adjust your tactics and the way that you use your toolbox differently according to the situation. Now, it doesn't mean it has to be an instant change, but there has to be a change that takes place. And then on top of that, of course, over the last 10 or 15 or 20 or 30 years, the nature and structure of the market have changed. So although they're still basically buying and selling, which is what we're all on about, the way in which that's executed, the impacts of other forces on the market are substantially different now, for instance, to what they were 10 years ago or what they were at the turn of the century.
So tell me a bit more about this, because some people claim or they see the market as being the same, price action being the same thing as it's always been because it's human factors. So they trade it the same way they've always traded it in the past. What do you think that changed, and is it a big difference people have to adapt to?
Oh, it's a massive difference that people have to adapt to. So, for instance, we have not had high-frequency trading in the market before, and this has completely changed the price behaviour of stocks that are impacted by HFT trading. We see a massive increase in exchange-traded funds and ETF activity within the market. That has substantial impacts on the stocks that are held by the ETFs, because the ETFs must constantly rebalance. That means, for instance, that even though you're holding a stock that is performing well, it may be subject to a sell down from an ETF simply as a rebalancing basis, which is not an accurate reflection of the underlying market demand for the stocks that you hold. These are major impacts on the market. The ability to be able to trade quickly, the ability to use algo trading in a much wider basis than we ever had in the past. These are substantial changes to the market. Think of it this way. The principles of flight haven't changed, but you would not use a 1942 manual for flying a Spitfire to trade today's markets flying an F-24 or an F-25. The principles remain the same, but the mechanics that we are dealing with are very, very different.
Interesting. I want to go back in time because you've been trading for quite a few years now, and you probably had some experience with different kind of markets before. I want to go back with, how did things start for you in trading? Was it a kind of you trying to kind of go in the market by yourself, or do you have some inspiration, some kind of people guiding you through trading to kind of get into it in the first place?
The answer to that is no, but perhaps you want a bit more detail than that.
Of course.
Okay. It is important in many ways because the way that I started trading has exerted a tremendous impact on how I trade and how I understand the market. Now, I know this is difficult for most of your viewers to understand. When I first started trading, I was living in the middle of the Australian outback. I lived in a small community of 200, 250 people. We had no radio. We had no television. We had no newspapers. Perfect trading conditions. My nearest town in the westerly direction was 400 kilometres, and it was a town of 1,000 people. In the easterly direction, my nearest town was 500 kilometres. It was slightly bigger. It had 800 people. So most people would not consider this to be ideal conditions to start trading the market. But that's where I did it. Now, we used to get one newspaper a week, and it was flown in on the mail plane. The only problem is that that newspaper was 1 week out of date. So having taken holidays from this isolated situation and gone into a much larger city of 250,000 odd people, I read about this fellow called Warren Buffett. Well, yeah, he's got some interesting ideas. So trade what you know. What do I know? Well, I'd worked underground, I'd chased gold, I'd put in roads for mining crews. I knew that type of industry. So I bought a company called Mount Isa Mines. That was only 500 kilometres away. I knew a bit about it. But having bought it, I then, of course, wanted to track its price activity. And I bought it, I can't remember the exact details, but I bought it, let's say, at $1. And over the next few weeks or so, it went up to $1.20, $1.30. There's a 30% return. I was feeling pretty smart. But then, remember, this is a 1 week delay. Price went down and down and down. It went back to 70 cents. He's sitting on substantial losses. Didn't feel quite so smart. Then it went back up. I sold it at $1.20 for a 20% loss. But to do that, I had to understand what price was telling me. There's no way that I could find out about the company. There was no access to fundamental information, to breaking news. I had to rely entirely on what price was telling me. So I had to learn to understand price and price behaviour. Now, that means that part of my focus is on price patterns, because there are several repeated price patterns available in the market. And when you identify them, they point the way to high probability outcomes. But more broadly, I need to understand how people were thinking about the stock. So I came to realise fairly quickly, first of all, I knew nothing. Everybody else in the market knew a lot more than I did, because at the very least, they had a week's lead on the information that I was getting. Secondly, that when people knew that information, they acted in the market. And if you could follow their price activity and the pattern of that price activity behaviour, then that gave you opportunities. You were either able to anticipate how price may develop, and pattern recognition and pattern trading is part of that, or you were able to join an established trend. So what became important is understanding the psychology of market participants, of those who are involved in the market. So the fact that I started trading in a very isolated situation, without access to all the information that people normally have, without having brokers chewing my ears, etc., meant that I had to develop tools and approaches that I just assumed were normal. But when we moved to a larger community, 2,500 people, I began to realise that, in fact, what I was doing was maybe not what everyone else was doing.
Interesting. Is your way of trading these days very similar to what it was back then, or is it more of an involved kind of trading, like more day-to-day in the market, like more intraday, basically? Or is it the same kind of principles apply?
No, basically the same types of principles apply. We don't trade intraday. I don't feel comfortable doing that. I don't invest for the long term, although some trades will continue for 5 or 6 or 7 or 8 months, as long as that trend continues. What I'm particularly interested in is breakout trades. That's where I like to believe I have some skill. Joining established trends, I don't do so well at that. I'm really skilled at picking the top of the trend rather than a continuation of the trend. So over time, you work out which areas you're most suitable for. And that's an important approach to trading. We have sometimes this idea that if I know how to trade, then I can trade anything, anywhere, at any time. That's not correct. The reality is that most of us are good at 1 or 2 things. So the challenge becomes to A, as quickly as possible, identify what you're good at. Then to seek out only those opportunities that are compatible with what you're good at. Now, I can look at charts retrospectively and say, oh, I should have been there. I could have bought that one. I could have ended that. Certainly true. But they're not situations that I feel comfortable with. So the odds are that I'd muck those trades up. So what I'm looking at is developments that are compatible with the way that I know I consistently trade successfully. Where do they happen? Anywhere. So I'm not stuck to a sector. I'm not stuck to a commodity. I'm not stuck to an instrument. What I'm looking for is the nature of the opportunity that's there, because I know that that's something I can trade consistently well.
How do you figure out what you're good at?
Well, one of the beautiful things about the market is your bank balance is a pretty good guide as to what you're good at. Obviously, if you're trying something, you're trying a new approach and it doesn't work, you lose money. You have a whole series of trades that either close at a loss or end up costing you a lot of money. So in that sense, your bank balance is a measure of your degree of success in what you're doing in the market. And that's something that doesn't apply in many other industries or professions.
So I'm guessing you had to go through trying out all kinds of trades possible and kind of seeing what works.
Oh, of course, everybody does that. Everybody does that. But again, because of the situation I found myself in, I was able to do some things that perhaps are not normally done. So remember, this is outback Australia. We have dirt roads. And I was travelling from a town back to my community. And I got bogged. And I was stranded for 3 days until things dried out enough to be able to move on. And of course, I always took reading material with me in case this happened. And I had a book called Colby and Myers, an encyclopedia of technical analysis. I'm assuming that some people will be familiar with it. So the structure of the book is simple. It took a single data series, in this case the Dow, and it applied 150 plus technical indicators to that data series. So here was the way I thought, here was the way that I could find out which was the magic indicator that was going to deliver superior results. Now, unless you're really dedicated, Colby and Myers is pretty dry reading. You need to be bogged in the outback for 3 days if you're going to read the thing from cover to cover, which is what I did. The surprising conclusion, there is not one single indicator covered in Colby and Myers that outperformed any other indicator to a significant extent. Let me say that again, because it's really important. There was not one single indicator that outperformed any other indicator to any significant extent. So the secret of the market didn't come from getting a better indicator. The success in the market depended on your ability to use a selected indicator to trade that market effectively. And that started talking about things like stop loss, about money management, about understanding what the 2% rule of money management really means, and that's widely misinterpreted. So these are the factors that come together to make a successful trader. But I think the foundation is you must work from the proposition that everybody else in the market knows a great deal more than you do. My task is to understand what you know and how you are backing your knowledge with money in the market by buying or selling. My task is to understand the tracks, as it were, the footprints that your money, along with others, is leaving in the market. Then I can decide whether I will join you, whether I will trade against you, or whether I'll stand aside and watch you crash and burn, as it were.
That's a good lesson, because a lot of people are still stuck in the indicator or the technique kind of cycle where they try to find a better technique to look at the market, better pattern, or sure, better indicator perhaps, but just doing that doesn't work very much long term.
Yeah, you will always find a combination of indicators that you feel most comfortable in using. So typically what happens, if you have some successes, you'll do your early trades, you'll be successful. Not satisfied with making money, you will begin to investigate a whole range of other techniques and approaches. That's good. But it's important that you do that investigation in a cautious fashion. In other words, you're not committing large sums of money to it. You're trying it out. And we do that all the time. So I know that the methods that I'm using at the moment will not necessarily be successful in 6 months' time or 8 months' time. So my choice is either to wait 6 months and find that I'm out of touch with the market and losing money where I should be making money, or to have another combination approach on hand that I've already been testing that I know is compatible with the emerging market. So the idea that we have just a single approach that we apply in all situations is also incorrect. As we go on, we tend to find that we have 2 or 3 approaches, and we modify those so that they become compatible with changing market conditions. The base will always remain the same. So I use a Guppy model moving average indicator to understand the psychology of the market. That tracks how investors and traders are thinking. I use a volatility-based stop loss to both open positions and to protect those positions as they develop. Now, that can be either the countback line or a new indicator we developed called Traders ATR, which is based on Wells Wilder's work, but the display structure is different on the chart. So they act as a stop loss. Now, most of the time, I find that they give me the answers and solutions that I want. It's pretty boring. You know, we do it time and time and time again. And every now and then they just get out of touch with the market. That's a good time to take a holiday, to take a break, wait for the market conditions to change and reuse them again. Because the single biggest advantage that we have as independent traders is we do not have to trade. Our colleagues stuck on the institutional desks, they've got no choice. They have to trade every day, irrespective of the market condition. But you and I, as independent traders, can wait until the ideal conditions develop for our particular trading approach, which means that we take the best trades possible. And they don't necessarily occur every day or every week. And when markets become very compatible with our preferred approach, we'll pile in and we'll make money out of that situation. When markets don't become compatible to our preferred approach, then we stand aside. Yeah, we can dribble a bit of money in here and there to try out new ideas, but essentially we're just dabbling around the sides. So the advantage of being able to trade when we want to trade, not having to trade every day, is really, really significant in that sense. And of course, as you would have gathered from my earlier discussion, the other thing I'm particularly interested in is chart pattern behaviour. And despite some interesting books that are written that claim to be able to recognise 150 different patterns that are absolutely useless, we put them to one side. There are about 6 or 7 patterns that are highly reliable. But even then, even though they're simple, people don't understand them. Take a triangle, for instance. How many sides does a triangle have?
Yeah, 3 sides.
3 sides. Okay. So when you look at a whole range of charting software that claims to be pattern recognition, how many times do you see 3 sides on a triangle pattern? It's not there. They show the horizontal line and the sloping trend line and say, that's a triangle. Really? It doesn't have 3 sides. And yet it's the 3rd side, the vertical base of that pattern, that's the most important feature, because that base gives you the height of the measured move, which is what makes the triangle pattern so powerful. Yes, it's part of an upwards continuation. So what? I can find that through 100 other methods. But what's really important about the upward sloping triangle, or downward sloping, is that the base of the triangle is projected above the horizontal line or below it in a downward sloping triangle to set a target, a measured price move. And there is a high probability that that target will be achieved. And that sets up a trading strategy. It means that you can enter that trade on the edge of the trend line. You can set your upside target, and depending on which markets you're trading, because markets change, so in the market that I trade most of all, I can put my sell order into that market in advance and it stays in that position. It sits at the head of the order line. So as price moves to that target, as soon as it hits it, my order is executed, even though it might be 3 or 4 or 5 weeks after I've placed the order. So that gives me a high probability trade in a way that you can't get from other trading environments. So you apply that same measured move projection to trading bands, the cup and handle patterns, so I said upward and downward equilateral triangle patterns, parabolic trends, etc. So the patterns, the chart patterns that you see in the market, the ones that are valid, not the imaginary ones, not the ones that are statistical blips, but the ones that are drawn essentially with a pen and a paper and a ruler, they capture the changing psychology of the market, and that is what you're trading.
Tell me more about this, because a lot of these patterns are easy to spot, but a lot of people don't understand really what they mean, or like what's behind them. Why do these patterns occur and why do they work? So as an example with the triangle, what would be the logic behind this kind of pattern and why it works?
Okay, let me answer it this way. I've just finished writing a novel. It's about 90,000 words. I like to think it's a pretty good story. Now, I can give you a pretty good story as to why an upward sloping triangle works or a cup and handle pattern works, but basically that's pretty much a work of fiction. But that doesn't stop me recognizing an upward sloping triangle. It doesn't stop me knowing that there is about an 80% probability that if the breakout takes place, then it will reach its measured move target. Intellectually, it's satisfying to give myself a story as to why this happens. Oh, it's because there's an increasing bullish pressure on here and there's a resistance there and those sort of things. Yeah, but so what? That's not important. What's important is that once that breakout takes place, for whatever reason, there's an 80% probability it will hit its upside target. That's what I need to know. Stories, yeah, they're great for reading to my grandchildren, but they're not so useful in understanding what's happening in the market.
Definitely interesting to put it that way, for sure.
Remember, one of the important things about trading, and I think it's in relation to a question you thought might ask me a bit later, is that uncommon results do not come from common thinking. There's a lot of mythology in the market, things that we take for granted as being correct, and they're not correct. Closer examination shows that they're a load of rubbish. But most traders, most investors, accept those as a given, as a bedrock of their understanding of the market, and go on to make consistent errors and consistent losses. And we know that the vast majority of traders who start at the beginning of 2023 will be washed out of the market before the end of 2023. Why? I would suggest partly because they don't analyse what they're doing enough. They take the common stuff that's there. So here's one, for example. Only use in the market money that you can afford to lose. Yeah, that's pretty standard advice. And it's absolutely wrong. Because if you go into the market firm and comfortable in the assumption that you're using money that you can afford to lose, then the one thing that's going to happen is that you will lose it.
I agree with that, yeah.
I go into the market.
Very true.
I go into the market. Yes, at the back of my mind, I can afford to take a small loss. I can't afford to lose all the money I'm using. So that means because I'm frightened, I'm worried, I'm cognizant of the risk and the loss that's there, it means I manage my money and my position and my exposure far, far more carefully. So the idea that you only use money you can afford to lose, great, you will lose it. Thank you, because you'll probably give it to me.
Love that. But at the same time, I'm going to ask, because these patterns that you see, like they're everywhere in books, people have written so many books about them, and I know you filter them out really, really well. So maybe that is a recipe for success. But with these patterns being so many places and so many books and so many like traders trying to use them, why are they different from common thinking?
Okay, so let's consider Tiger Woods. You can go out and you can buy videos of Tiger Woods in slow motion and he shows you exactly how he plays his golf. Everybody knows those secrets. And how many Tiger Woods are there? It's the skill that is required. And think about it. We all sit down and we all look at exactly the same charts at the end of the day at the same time. And yet, the conclusions we reach about those charts vary tremendously. That's what makes the market. You see the charts going up. I see the charts reaching a top, therefore I'll go short. Someone else sees that this is a continuation of a trend, whereas I see that the trend's weakening. So we're all looking at exactly the same information. And there is no single interpretation that is correct, by which I mean there is no single interpretation which is profitable. There are multiple interpretations, multiple participations within that existing chart that will return a profit, depending on which trading techniques that you're using. Now, some of them will not return a profit, and you manage that by cutting a loss very quickly. So the fact that a pattern is common, the fact that it's seen by lots and lots of people, doesn't invalidate the way that pattern behaves, because that pattern captures the psychology of the market. It is my thinking extrapolated more broadly within the market. So I look at a stock. Okay, let's talk about a resistance level, and we'll use an upward sloping trend line triangle pattern as the example. So I'm thinking it's hit resistance multiple times. Let's say $1 makes life easy. Okay, there's a reasonable chance of a breakout here. Back a couple of weeks ago, I was waiting for price to pull back a bit further so I could buy it, but it doesn't pull back that far. I've got to chase price to be able to get a position. The impact on that on a chart, it creates that upsloping trend line. My thinking is the same as your thinking, and anyone else who's watching that price activity, we're saying, oh, this is moving up. The upward pressure, the bullish pressure is there. It's going to get better and better. It's going to break the resistance level and then break out. Now, I will say it'll break out and it will make that measured move. You might say it's going to be the beginning of a new long-term trend, so you don't have a price target. So it's the psychology of all the other participants who are watching that particular stock that is encapsulated in that price behavior. And here's an important warning. That applies to stocks. It does not apply to commodities. It does not apply to indexes. It does not apply to currencies. Why? Because it doesn't apply to ETFs. Because once you start talking about ETFs and talking about indexes, you're talking about an aggregated behavior from multiple stocks into an individual instrument. Whereas if I'm talking about stock ABC, I'm talking about one stock and the group of investors who are involved in that one stock. So the psychological impact is much, much concentrated on that stock. An ETF, it's diluted. An index is diluted even further. And if we're talking foreign currency, then FX is an entirely different environment. So we need to be very careful when we see chart patterns appearing on FX. We need to be careful not to apply the conclusions that we would apply if those chart patterns occurred in an ordinary stock chart. They don't have the same level of reliability. There is some validity there, but not the same level of reliability.
How would you switch it up for, let's say, Forex or indexes? Would you kind of look at different patterns, be more strict about them, or how would things change?
No, we tend to trade FX purely on a statistical basis, and that's covered in some of my more recent books. So what we're looking for is changes in volatility behavior that give us the leading indication of how price is likely to break out and the sort of daily range of moves that are likely to take place. So in my most recent book, Stocks on FX Trading, written by myself in conjunction with Karen Wong, we discuss that in much, much more detail. So we don't use a psychological approach to FX trading because the FX market in itself is a constructed market, like derivative markets, as distinct from a market that is, I'll use the term, perhaps a genuine meeting place between buyers and sellers who have a particular opinion about an individual stock or company. Because remember, in FX markets, you've got, and we're going to exaggerate a little bit here. In an FX market, you've got 50% of people who do not want to be in that market. Why is that? Think about it. Who are the major players in the market, in the FX market? It's the banks and the institutions. So when you buy something from Amazon, the bank has to take the opposite side of your currency trade, irrespective of its view on that currency. It might not want to be on that side of the trade, but it's part of his business, has no choice. So that means that the behaviour in the currency market is distorted to some extent by the need for major participants to take a position that does not necessarily match the position they would prefer to take. They have to take the opposite side of their customers' trades. And that impacts on the way that market behaves. So you can't transfer the psychology that you see on an individual stock chart to an FX chart. So what you have to work on is changes in volatility, changes in range behaviour. And we use average daily range. And again, those particular techniques are explained more fully in my most recent book.
Yeah, I'll definitely have to have a look at that. I'm curious about how you look at you look at things. Next thing I want to cover and talk about is the 2% rule. You mentioned it earlier a little bit, but what does that 2% rule entails, and why is it so kind of misinterpreted or not used correctly in the market?
Okay, so the rule is don't risk more than 2% of your capital in any individual trade. Now, many people read that, and it was popularised by Dr. Alexander Elder, initially in his Trading for a Living, but he didn't fully explain it. So people read this and said, I've got $100,000. That means I can only buy a position for $2,000. Wrong. And they threw the rule out of the window as a result. What it means is that the loss on any individual trade cannot be more than 2% of my total trading capital. So I've got $100,000. It means that once my trade loses $2,000, I have to close the trade, because all I've got at risk is 2% of capital. The actual value of the position might be $10 or $20 or $30 or $40,000. But as soon as I've lost 2% of total trading capital, then I'm out of the trade. Now that means that the loss, and this is the magic stuff, that means that the loss on the individual trade may be 10 or 20% in terms of the trade value, but the quantum of the loss, $2,000, is still only 2% of my total portfolio capital. And once you understand that rule, then that becomes a foundation of long-term success in the market, because it means that your losses are never going to exceed 2% of your total trading capital, even though they may be 10 or 15% on the individual trade. Now, of course, you will get caught on occasion when prices gap below your stop loss and you get out at a worse outcome, but then that's balanced by the time you get out at a better outcome. So on average, 2%. And for traders like independent traders, that's probably a good value. Don't let it go to 3%. For large institutional traders, they'll be trading at 0.5% or 1%. But the key factor, it's not 2% of your total trading capital. It's the dollar value of that 2% that you're not prepared to lose in an individual trade, which then comes into the next point. How do you set your stop loss? Okay, I can set it on a financial basis. So I've entered at $1, and once it gets to 98 cents, I'm out because I've lost $2,000. Well, that's pretty unintelligent, because how does that relate to the natural activity of price? What I want to know is what's the volatility of the price in the instrument I'm dealing with. Is its normal daily range $5, for instance? Is it $10? And for that, I need some volatility measures. I can use a countback line, quick and easy to calculate. I can use a trader's ATR line, which, as I said, is based on Wells Wilder's work. Again, fairly easy and quick to calculate, but the display that we use places that value under the price candles on the chart. So if we get a move that is larger than normal volatility, there's a reasonable chance that trend will change, so we get out of the trade. So the question becomes, how do we determine our entry point at $1? How far do we fall to the volatility-based stop, which might be at 97 cents rather than 98, for argument's sake? Then that will determine our position size, so that when the loss is taken, it only is equal to 2% of our total trading capital. It's a simple concept, but it's one that many, many traders do not seem to be able to understand. So they either set a financially based stop loss, which gets them out of trades early, false exits, or they set a volatility-based stop loss, 5%, 10%, whatever other method they use, and end up losing more than 2% of their total trading capital because their position size is incorrect. So these are the mechanics. Selecting the trade, yep, we can all do that relatively well. Most of us get it right at least 50% of the time, and that's all you need. You can make money on that. But it's how you manage that trade in terms of the position size and the degree of loss that you're prepared to take on that trade. That's what determines success. Not whether you're successful in saying, yes, 8 out of 10 times the stocks I select go up. That's irrelevant. It's the 1 or 2 that go down that will kill you.
Does that 2% rule for any does that work for any kind of trading, or is it mainly for swing trading or long-term position? Because I would argue someone who day trades or trades like multiple trades a day or multiple trades a week, with 2% to trade might kind of get in trouble.
I would suggest, and what we've used, is that 2% is the maximum amount. In some instruments, in some trades, we'll reduce that to 1%. And in fact, depending on market conditions, in a bullish condition, a bullish market, where you can't make any mistakes, as it were, unless you're really stupid, then 2% is great. But as markets become more fractious, then we'll cut that position back to 1%, or maybe even 0.5%. Depending on what instruments we're trading, we'll tighten that, but it never exceeds 2%. Who are the biggest losers in the market? Investors. Because they believe that they can predict what's going to happen. They believe that on the basis of all their research, all of their analysis, going to golf with the managing director, all the rest of the stuff, that they've got the answer to the future. So they don't use a stop loss. They don't need to, because they believe that their analysis method gives them that protection. They can't be wrong. We don't believe that as traders. I know that I can be wrong. Hopefully not more than 50% of the time, but I can live with that if it gets worse. That most of the time when I enter a position, it's going to develop as I expected. Not that it's necessarily going to hit the targets that I've set, but it's going to develop moving upwards, because I don't trade short. That's just a personal preference. And my stop loss is designed to protect me when I make a mistake. But the same method is also designed to lock in the maximum amount of profit available from that trend as it develops. So the stop loss has 2 functions. First, to protect capital. As the trade develops, to protect profit. And we use the same methodology.
Interesting. We've heard a lot here so far, and I want to have time for you to kind of share about a bit more about what you do where people can find you. So if you want to explain your most recent book, you talk about it a little bit, but explain where people can find you, connect with you, and see kind of the work you're doing out there.
Well, they can obviously go to the website, which is www.guppytraders.com, and links to the book are there as well. So I said it's a book I wrote in conjunction with a colleague, Karen Wong, and it looks at a range of trading techniques that we apply in the current market conditions. What we're looking for, how they apply, how they don't apply, because it's just as important to know when you've made a mistake, when the analysis is incorrect, when it's not developing as you anticipated. So you've always got to know what indicates that you're on the right track, but also what indicates you're on the wrong track.
Awesome. So we'll put a link in the description below of the video on the podcast. People can check it out and connect with you there and see your books. I know you've written a lot of them. I read a few of them in the past. I think you're going to check out your Forex one that you published 2 years ago now. So that's going to be something to look for very interestingly. And definitely look forward to connect with you again. I think it would be good to catch up in a few months, see how things are doing, see how the market evolves, and kind of discuss more about your methods for trading the market. So I'd be really happy to connect with you. And I appreciate the advice you gave here to my listeners, my viewers.